Welcome to Investing Insights, partnered by Right Property Group. This is your host, Phil Tarrant.
Well, g'day everyone, it's Phil Tarrant here. How you going? Thanks for joining us for our next instalment of Investing Insights with the Right Property Group. For those of you who are new to this particular episode, or if you haven't found Investing Insights with the Right Property Group beforehand, we try and sort of dig deep into some of the issues which are really impacting property investors. So if you found us from the Smart Property Investment Show, you know I like to share stories with investors about how they go about investing in property. What this particular podcast is about is that I've asked my buyer's agents and good friends of Smart Property Investment, the guys from the Right Property Group, to come in and actually dig deep into some of the strategies around property investment. We'll look at some of the often complicated terms that you might hear, but also try and simplify property investment so that we can make it not a scary factor that might inhibit you from investing in property, but make it something that should be able to empower you to go about and create wealth through property. So I've got our regular guest hosts in the studio, Steve Waters and Victor Kumar. How you going, guys?
Yeah, good mate. How are you?
Good. So as I mentioned, I like a lot of storytelling around property investment, and everyone's story is a little bit different. And I think you guys, as professionals that work as buyers agents for investors, probably hear every single story known to man. Everyone's very different, and I think that's what a lot of people often forget when they listen to podcasts like this, that everyone's circumstances is very different. So you need to make sure that your property investment strategy is right for you. What I want to do today is something which really resonated with me, Steve, when we first met all those years ago. You used the term, probably from our first meeting, around manufacturing equity. And I sort of got thinking about that. And I like the idea of manufacturing. It means you're making stuff, and equity being something which all property investors want. Right? You don't want negative equity.
No, not
you
at all.
want positive equity. So I want to do a podcast around the art of manufacturing equity. So to me, this means essentially either manufacturing equity through purchasing well, so you don't need to do anything whatsoever.
Yep.
Or purchasing an asset that you can spend money on and amplify that money so you can turn $1 into X dollars in capital value. So that's the focus for today. You guys happy to touch on that?
Let's do it.
I don't know if that's your term or something that's been bandied around so much. Right?
No, we made it up.
I think it's mine. It's not my term, is it, manufacturing equity?
No, it's mine. Yeah.
It's your term. You take stake to that. So let's just deal with a definition. What is manufacturing equity for our listeners?
Spending $1 to make $1. So taking something that perhaps is a little cosmetically challenged, and we tend to steer away from structural renovations because it costs a lot more. There's a lot more inherent danger or risk, so to speak. So cosmetic renovations, something that you can spend a little, make a lot, but you've really got to have the combination of buying it under market value as well, and knowing what the purpose of the dollars that you're going to spend, what's the result going to be for you, whether it be cash flow or equity.
Okay, so let's talk about that process then. Identifying under market value property and then securing that property for that price. So if the market says $400,000 for a property, and you might find something which is at the $350,000 range, which is hard to find, and the skill of a buyer's agent, you typically sniff out those deals, but it actually might be a $350,000 property because the state that it's in today is what the market says is $350,000. Now, we can talk about some of my experience and the stuff that you've bought for me later, but that could actually be a $400,000 property or $450,000 property should you spend a few bucks to bring it to the standard to other properties in the area which get the sort of same
and
amount.
I think and the really important point here is actually identifying what market value is. As you say, just because it might be really badly cosmetically challenged and we're buying it for $350,000, but that's probably what it's worth, even though it's potentially under market value by spending the dollars to it. Because remember, at the end of the day, if it's worth what someone will pay for it. It's whether you can actually see the warts and work with the warts on the property and perhaps take advantage of a situation better and cheaper than anybody else. But that's all part of your diligence. That's all part of your research. A lot of people get unstuck with renovations because they think they can do it in a specified time frame. They think they can do it for a certain budget, and they think that an end product will be worth X when sometimes they get the trifecta of being wrong. And we've seen the results of that quite often, even today.
Yeah, I think, Steve, with when you're talking about renovations, often what happens is that people go to these seminars, and depending on how many seminars they are on in terms of renovations, depending on the phase of the market and all of this sort of stuff, a lot of people do get caught up in this, and they end up actually paying a lot more than an actually okay property, so a already renovated property. They see something which has been advertised as a handyman special or a renovation potential, and they end up paying far more than what it would have been fixed up.
And it's part of every cycle. We talked about this last cycle as well, where we used to joke around saying we may as well just trash our properties and put them on the market because they seem to be getting more dollars than what a good conditioned property is. And as Vic says, there's so many courses out there now that advocate and teach you how to be a renovator. And a lot of them are really good courses, but there's no secrets to it. It's just really that the trick to renovation is the costing and knowing what to do.
And buying well to begin with.
It all starts with that.
It comes down to buying well, and we'll touch on how to maximise renovation potential by doing it as cost effective as possible. I just want to drill down on this concept of under market value, and I talk a lot about it. You guys do as well, and most people bandy the term around at some point.
Yeah.
It's the investor holy grail to buy something for less than what it's worth, right?
Yeah.
But let's talk about that. So what you pay for something is what it is worth. The market has dictated that property is worth X.
Yeah.
Now, you might be able to see as as a professional buyer's agent, or myself as someone who does a lot of investing, actually, I can actually create something out of this. The blank canvas is okay. I can create something out of this to manufacture that to a point where it can be worth a lot more. But it is what it is. The properties, and I'll use an example. We purchased a property that you guys negotiated for us. It must be sort of 4 or 5 years ago. That place out at Cambridge Park.
Yeah, good example. Yeah.
We paid $235,000 for it. It was a 4-bedroom property, Cambridge Park, which is near Penrith, and we got it at auction for $235,000.
Yeah,
that's what the property is worth, right?
Yeah.
It was actually worth less than that when you consider it, because the bank said, "Hang on a second, that property is so bad that we're only going to give you
Land value.
we're going to lend you
Land
on the
value.
value of the land, right?" So,
Because it was uninhabitable.
because uninhabitable. That's how bad it was, right?
Correct.
We renovated that property.
Yep.
I think we lifted its capital growth by about 100 plus grand. I can't remember exactly, but it's all on smart investment. That today is a 600-ish grand property.
Yeah, 650. Yeah, and that's only in a space of 5 years.
5 years.
But interestingly enough, with that very same property, if you had not have touched it, we bought it for 230. If you had not have touched it, it's still probably worth 450 today. Just purely because of the market growth. So what the renovation has done is it just promoted its value.
Yeah, it's just amplified what it could be.
Correct.
And now, rather than being the crappiest house on the street that is in Cambridge Park, it's not the best one, but it's sort of somewhere in the middle to probably the 60% range. And
So it's given you equity, but it's also given you really good cash flow as well.
great equity, great cash flow. So that property was under market value, but it was actually worth what it was worth.
Yep.
So
on that day.
So we were able to see the upsides in that property, and this is the trick in terms of the art of manufacturing equity.
Is being able to identify that upside, and the upside is not always about equity, as we mentioned before. It might be the cash flow, or it might be, in a perfect world, you want the combination of growth equity and cash flow. You need to identify where to spend the money. What areas of the property do you need to put the most dollars in to get the best return on that dollar?
So let's deal with those two concepts, Victor. So equity, so growth in the capital value of it, and then also yield or the cash flow. So under market value property, okay, let's look to manufacturing equity through a renovation. We'll deal with that in a second in terms of how you go about doing that. But the purpose of manufacturing equity is to try and make the property be worth more, but also allow you to rent it out to more to help cover the cost of holding that property.
That's correct. Or to get a better quality tenant. Yeah, because if the property is really shabby, it's unlikely.
You were going to say shabby then.
I got a filter. So if it's really rough, you'll more than likely get rougher tenants. Whereas if it's in reasonable presentation, then you're likely to get better quality tenants. And you need to actually involve your property manager to give you that recommendation, taking into account that some property managers do go over the top a bit. So you need to obviously tone it down, and that helps rent it out faster. It helps get a better tenant, as opposed to not doing anything to it. Sometimes that is a better way as well, because you're not actually getting much bang for your buck if you're renovating straight away. And it may be just as easy to drop your rent by $10, get it rented out, and then possibly do a renovation down the track when the market is more better for it. And also, if you spoke with your accountant, there'd be better tax benefits of doing it that way as well.
Is it possible when you look at this, the art of manufacturing equity, is it possible to achieve both capital growth and also achieve cash flow increases through a renovation? Should you be looking for one over the other? How do you work out, do I wait and hold and don't do a renovation and potentially decrease the amount of income I'm going to receive off it? How do you balance all those different things?
Yeah, it comes back to where your portfolio is at. So in terms of whether your portfolio actually needs an injection of equity to help you propel to the next property, as an example, or whether it is something that you're doing as Steve and I have done in our portfolio, and our joint portfolio, where we actually bought a property specifically to create that equity so we could recapitalize to start the second phase of buying in that sense. So it comes back to where the portfolio is, what your goals are, and certainly in the ideal world, you want both.
And a little bit further from that, it depends on your capital position. So you don't want to renovate just
for
to
the sake
renovate.
of it.
Yeah. And also take into account that if I buy a house for $300,000, spend $20,000 on it, I still can't get a valuer in within a couple of months to get a relevant result. There's that time period that needs to happen before you want to send the valuers in, or before the lenders have their own requirements or their own policies. So,
especially in today's market,
especially in
with the
today's lending environment. So it actually may be better to hang on to the capital that you'd spend or use for the renovation and use that as your buffer or as part of your next purchase, whatever it may be, as long as the house or the unit or the townhouse, whatever it may be, is still in a rentable, safe condition, and make the money work for you. And that may not mean that you renovate straight away.
I imagine you guys do this on autopilot, and that is understanding where the upside for a property is. You professional buyers, buyers agents, so it's an innate skill that you have to be able to go, I know this market so well that I know this property in this state will get this rent and be worth this much money. You do it every day.
Yep.
But for people who don't use buyers agents, what's your recommendations around understanding whether or not to do a renovation? So do I speak to a real estate agent and say, how does that work? Because I imagine you probably still speak to agents to get this
We always do,
information.
because the market is quite fluid and it does change sometimes weekly. And so I would suggest that the first port of call is when you're actually purchasing the property or you're negotiating it, and you've built up relationships with agents, hopefully, that you actually start to run numbers past them. If I replace the kitchen, is it going to increase the value? If I do the bathroom, is it going to increase its value? And then doing the numbers back and forth that way. But on the rental side of things, you should be speaking a lot to your property manager and finding out what the return on your dollar is going to be there if you do these improvements. Is it going to be a better tenant? Is it going to be better cash flow? And of course, then speak with your accountant. And this needs to be all in the one pot. And it has to happen before you actually really go unconditional on the property.
Yeah,
if this is the
So
first
you need
time
to
around the
know why you're buying this particular asset. Is this going to be a
What's the end goal for the
manufacturing
property?
equity play,
Yep.
or it's going to just be I'm going to leave it and let it sit there? And your recommendation to me on a number of the properties that we've purchased is just leave it. You know, at a point in time, let's spend some dollars on it and look for an upside. But your portfolio at this point in time, you don't need to do that. You're not going to get the upsides. Your money's spent better doing elsewhere, and you touched on that before.
Absolutely, and the market will dictate as well whether you should renovate. Like if you look at the Sydney market at the moment, or even over the last couple of years, you'd have probably been better off not renovating, as long as the house was habitable and safe and what have you, or the property, and actually using that capital.
It's going to grow anyway, right?
Yeah, it's going to grow anyway, but also using that capital that you would have spent to perhaps control another property within the Sydney market and had double the effect. Now, obviously, financial positions and what have you change, but you don't always have to renovate. Queensland at the moment, or Brisbane market in certain areas, it's a bit of a combination of sometimes you don't have to renovate and sometimes you need to in today's market to accentuate the growth or the capital value, or the cash flow. Here's a really good current example, and we'll use Adelaide as an example.
Yep.
So we bought a couple of blocks of units down there, individual, already strata titled, so our clients all got one each, and we purchased them for
225 to 255, depending on the number of
and
bedrooms.
how many bedrooms. And they were just purely under market value, giving, I think it was about a 7% yield. This is only going back 8 months now, if that. And because we're quite a fan of the Adelaide market in that particular area, not the whole Adelaide market, today there are some public buyers in there, because we couldn't get the whole block. We got like about 95% of them who have renovated the unit. So 8 months later, and are getting in excess of $310,000 for these very same units. Now, if we were to put the unrenovated ones on the market, because none of our clients have renovated it, there would be some pretty good inherent capital growth there, and we bought under market value.
Well.
Yeah. But to do, say, a $15,000 renovation on a 2-bedroom unit, they're going to be then probably getting $2 for one spent. Now, even though I've just mentioned the 2 for 1 sort of theory or formula,
There's no magic formula.
there is no magic formula. That's correct. Yes, there are some people out there that teach inverted commas, that you should get 5 for $1 or 3 for $1. But I just think that's crap. That's rubbish.
The market will dictate that.
Correct.
But this comes to your assessment, right? If
Yeah.
you know that speaking to a real estate agent or your buyer's agent would say, you purchase for X, we can rent it out at Y, and it's going to, because we've purchased under market value, if we wait 6 months to 12 months, we'll probably get a valuation of whatever, right? And that's understanding the market, or we get this particular yield. So it might cost you $50,000 to do a reno, and you might estimate based on research that you might be able to get another $20 a week rent, and you should bring your capital value up to whatever it is based on comparables. But it's never going to be $1 for $2, $2
Never.
for $4, whatever.
Never.
The market will dictate that.
Yeah, and absolutely. And on the cash flow side of things, there's people often say, well, should I spend $10,000 on a renovation to create an extra $10 a week rent? And the quite simple, and let's pretend capital, so your capital wasn't an issue. The real easy way to determine whether you should is the return on that dollar is in terms of a percentage. I'm talking about cash flow here. So it's just quite simple. If I'm going to get an extra $520 a year, so $10 a week, what's my yield based on that? Just like you'd work out a yield in purchasing a property. Am I going to get, say 7% return on that invested money versus keeping it in a bank account getting 2% or 1%?
And that's pretty pertinent. One of the clients I recommended recently not to actually do a renovation. It was going to cost him $25,000 to renovate this particular house. I got him to explore with the property manager if he just dropped his rent by $10 and rented the property out, give it a really good clean and rent it out as is. Would he be able to get a tenant, a good tenant, and hold that property? And the answer was yes. So he's lost $500 in cash flow a year, but he's managed to save his 25-odd-K, which is a deposit on another property, or part of a deposit on another property. So you need to look at it from a holistic point of view. The reality is that with these changes that have happened with the federal budget, so one of the big changes that happened was the depreciation rules. In other words, you've got to spend the money before you can claim depreciation on fixtures and fittings. Right?
Yeah.
So there will be a run of investors that are going to chase that dollar and therefore go for these renovation potential properties, which would mean that potentially these renovation potential properties will be a lot more expensive and sought after than a already renovated property. So that's just a heads up to the listeners, is that you've got to do your market research. You need to make sure that you understand the market that you're buying in and know the suburb, know it street by street, so that you're actually looking at it from a perspective of, okay, if I did spend the money on it, am I really making money, or am I just doing the renovation for the sake of doing it?
Just for the sake of it, because everyone loves to do a renovation, except maybe you, Vic.
Oh yeah, expertise. Remember that expertise can be bought. I've done hundreds of renovations, no exaggeration, but I can't even drive a nail straight.
Yeah.
So you don't have to be a renovator.
I want to grab your point, Victor, because I think it's a very good point, and a couple of remarks I would make around that.
About the ability not to do a renovation?
No, I've seen it, mate. But two comments. Number one would be for our listeners who don't use a buyer's agent, who like to do it themselves, and that's cool. You're up against people like the guys at Right Property Group who do this all the time, and they know these markets inside out. So if you get carried away with the idea of renovation, if you get carried away with the glamour of choosing colours on walls and stuff, typically you're either not going to buy well or you're going to overcapitalise on renovations. And your point about looking at things you can't control, so changes the budget, which is influencing depreciation, but the flow and effect of that being that more people might seek renovation-orientated properties because they can think they can spend a couple of bucks to get a couple of bucks back. Spend three, get one back in terms of
great business sense, right?
a tax outcome. But match that with overcapitalising, spending money on a property that's not going to allow you to really get too much more rent because the market might not dictate that. There's so many moving parts associated with this that it's a minefield. I wouldn't do it myself. I wouldn't be confident to make that call.
And of course, we've know of many stories where partners have broken up because of renovations because they can't see eye to eye.
Well, don't you guys have a really good referral thing with family law solicitors where you wreck a relationship through a reno? Go, here you go.
Ambulance chases? No, not at all.
Renovations bind together relationships. That's what I find. But But anyway, that's for a different topic.
That'd actually be a pretty good topic.
It would be, actually.
But just now coming back to Victor's point, but let's do the flip side. So away from tax for a minute, and let's talk about the lending environment and wanting to perhaps recycle your capital after you've done a renovation, so to accentuate its value, then get a valuer in. Because of the lending environment today and perhaps the downward pressure all the way through to the valuer, who are completely independent, of course, there might be a little bit of pressure but on them and a little bit of doubt within the market on them to actually value well, let's say in inverted commas. So perhaps a house that is in run-down condition, yet still habitable, obviously, and very safe, and it's still renting, versus one that's been cosmetically enhanced, or it may get the better valuation, not just purely because it is a better house and it's cosmetically better, but just because it's a more saleable, less risky item between a valuer's ears or in their eyes, so to speak. So renovations might, on the other hand, actually come into play when you're looking to get a better valuation in today's lending environment.
Absolutely.
Because I think the sting will come out of the market from a confidence point of view. And that means everybody, from the purchaser to the lender to the valuer.
There is, as I said before, so many moving parts of this sort of art of manufacturing equity, and
so that's why the best thing to do is just keep it really simple.
Keep it simple.
And I think with the lending changes and all that, the first thing that you need to do is, if you're negotiating on a property or looking at buying a property, is make sure that the lender is going to support a earlier valuation. So what I mean by that is when you're going back to recoup your money, is the lender, are you still able to qualify for a higher loan with that particular lender? So is one point. The other point is, does the lender have a policy where they will not allow you to top up your loans within the first 6 months, as an example?
Or a cash out.
Cash out, And then the equally important point is that, let's say your renovation budget is 20,000. Double it. Because things won't go according to plan unless you've done that thousands of times. Even then, you'll have the surprises.
Well, let's talk about that. So, double the budget because of a million different reasons, but probably the main one is try and get a tradesman at the moment.
Especially in today's market.
On the eastern seaboard, you just can't get them. They'll name their own price, and then there's a waiting time to get them, no matter how.
So waiting time means more holding costs, which
it all adds up. Yeah. Now, unless of course you want to do the work yourself, which we call sweat.
Another term that I've phrased.
Sorry, one of Phil's phrases, sweat equity, which does pay dividends. But then
just on that, all the things I've lifted from you guys, sweat equity, pigeon pairing, which you sort of spoke about.
We sit back and we listen to you with other people saying,
I always disclose it, so I'll get it from someone
Bread and butter properties.
But you're not the only one that does it, that's fine.
That's all right.
It bills in the mail. So I think people really need to be true. They need to be real. Renovations aren't easy. They're very rewarding, and if you can get a system down pat, like if you're that person that wants to get in and not just project manage but get their hands dirty, so to speak, it is a pretty simple process to do a renovation.
Rewarding.
It's quite repetitive.
Well, let's chat about this then. So how to spend? So the goal is to spend as little as possible for the maximum upside. So maximum upside being growth in capital value and growth in yield, right? So I've seen you do it, and we've done a number of renos that you've offered me advice on, and you walk into, you walk into a property and your mind just goes, you see it all in one, I've got to do that, don't do that, don't do that. So let's try and get some of that info out of your brain. When you walk into a property, what are the things you look at that you know that if you were to spend a few bucks on it, you've got to maximise yield and growth?
And actually, for me, it starts at the curb because
start thinking like a valuer.
And a tenant or a buyer, just from whichever direction you have to think of, I suppose. So I'm looking at the facade, whether it's a
curb
unit
appeal,
block,
another
term. That's it, right? Don't get a second chance to make a first impression. So I'm looking, for me, the front door and the gutters. Because if you've got rusty gutters or something like that, they stick out. So paint them. Paint your fascia board.
Paint out the green.
Paint out the mission brown. Yeah. But the front door is huge to me, and clean lawns. No gardens and all that sort of rubbish. Just have it lawn. And what's your thing? Red bark.
Bark. Works a treat.
And then once I'm into the property, and sorry, the front door, like make sure it fits properly. Doesn't
You
cost
like it,
you.
you
anything.
really like it. I remember you always go front door, Phil. Paint that red, so
Yeah.
make it a feature, make it look
Yeah.
make it look warm and inviting.
Absolutely, because you think of yourself as a tenant or a buyer coming into the house for the first time. They can't get the front door open because you haven't fitted it properly.
Yeah,
Like
it's swelled up in the wet weather and
Yeah.
give it a kick at the bottom.
So and we speak to valuers all the time, and all these sorts of things they add up subconsciously to make to give them some sort of direction when they put pen to paper. Yeah. So as you walk in, as you open the front door, massive on paint. Paint is probably the best value for your money spent if you do it correctly. So don't be the person that says, you know what, I'm going to paint the walls and I'll save on light switches, so I'll paint the light switches, or I'll paint the light fittings. Yeah, and I've seen it. It's
crap.
So do it and do it properly. If you can't paint, and I'm yet to meet too many people that can't paint,
Except me.
except I'm looking at Vic now, then hire someone to do it and get them to do a good job. It makes all the difference. Best bang for the dollars. And then, of course, there's your big ticket items. So there's your kitchens and your bathrooms. But it's amazing how many times we see people get caught on the kitchen and bathroom areas where they'll get 3 quotes, but they'll be from 3 random companies. Let's talk kitchens. And quotes on a 3-bedroom standard house are coming in for the kitchen at $25,000 or $15,000 or something like that. I'm like, that's just crazy. Like, obviously prices have gone up, but you can have someone come in for a standard kitchen and you'd be out of there for $8,000, and that's everything. So we're talking about tilers, flooring, sparky for that particular area, oven. Yeah. Then obviously the bathroom as well. So save yourself some money. Don't tile to the ceiling. That's overkill. It's not Kirribilli. It's and just keep things standard. And for us, when we talk about standard, we got a colour stylist in.
Yep.
And we got them to pick out several colours on which we can use for certain different properties with certain aspects and what have you. And to this day, we still use those colours.
Mate, testament to that, the last reno that we did that you sort of gave me some advice on, I've still got a tub of that paint
There you go,
in my
see?
mum's garage waiting for the next one.
I'll come around and get it because I've got
You
to.
need it. Well, it's on special at the moment.
So we use the same colour, and it's a neutral colour, obviously, and we use it everywhere. Doesn't matter what state.
The same kitchen designs.
Same
as
kitchen design.
What's really funny is that I can look at properties on realestate.com and I know if you guys have been there.
It's the same
like the colour.
tiles.
Yeah.
And if you're a DIYer, it's all right, DIY.
Yeah, that's okay.
Usually the rule of thumb is for every sort of 3 renovations you do, the 4th one will be free in materials.
Yeah.
So you'll have enough
Look
paint
after
left.
your materials.
Yeah. There'll be enough paint left over. There'll be enough tiles left over. But don't be the person either that goes too far in trying to save $1 and my pet hate is like plastic tap handles.
Yeah.
That you'll get from Bunnings for
will
$1.90.
break in a year.
They break in a heartbeat. So get decent quality stuff for stuff that gets used 100 times a day, such as your tap handles. Same with carpet. If you're going to put carpet down, don't get
Cheapest
the
stuff
cheapest stuff, which is thin as. And then, of course, renovate to the demographic. So the only reason that comes into my head, that if I look, I'm talking about carpet, of course, if I look to some areas of, say, Sydney, because this is where we are today, there are certain parts of, say, perhaps the Parramatta Railway line where I will not put carpet down. I'll tile instead, purely because of the demographic.
Yeah, it's a good point.
And
So
it gives me
renovate
longevity.
for purpose, renovate
Absolutely.
for the demographic.
Yeah. Not to your taste, but
not
to what's going to get you the big
This is a big
result.
thing because a lot of people get carried away. They get emotionally invested. And to your point earlier, Victor, the decisions around this needs to be made on a spreadsheet.
That's
it's
right.
about the numbers, and that's
Yep.
based on sound research and intelligence. So that's where the decisions need to be made. When you say, "I've made a decision to renovate," how do we maximise the renovation? Where do we spend the money? And you've outlined some of them right now. But a lot of people sort of start and they go, "Oh, wouldn't it be nice to do X?" Or, "Oh, I might just do that," and it just blows out of proportion. You've got to sit down. At the absolute get-go, create yourself a budget and don't deviate from it. Obviously, plan for the best, that is to keep on budget.
Yep.
Hope for the best, plan for the worst, and that is you're probably going to spend more than what you want to.
Yep.
But if you stay on budget and buy materials correctly and you're willing to roll up your sleeves and do a bit of your sweat equity yourself, go and do it.
You'll save $1, and landscaping's a big one. Like, I just remember Cambridge Park, actually, where you guys were doing.
I got my mum out there
I
planning out.
Talk about sweat equity, right? But I remember you guys were laying all the turf.
Yeah.
Saving a fortune. You did the gut out or the strip out yourselves. You saved a fortune.
We pretty much did. The thing is that, and this is another point, it's probably another, we could cover it another time, but the balance of do you do it yourself and versus getting other people to do it. And I quite enjoy reno. I get a lot of satisfaction out of it. I'm probably a little bit more capable than Victor is. I can do most things. I can tile. I can pretty much do everything except that isn't specialised trades like plumbing.
That's the key.
Or electrical, and you shouldn't touch that stuff.
So any of the sort of the unskilled labour, if you have the time, and that's the key. The key here is if you have the time, then do it yourself, because you will save massive dollars. A handyman, for an example, is $55 an hour.
Yeah.
Unless you're earning $100 an hour, then your time's your time. But any of the skilled stuff, any of the stuff that requires licensing, such as perhaps plumbing, especially being an electrician, Sparky.
Yeah, absolutely.
You don't want to touch that stuff.
No.
It's
and
just
you have
not
a duty
worth
of
it.
care to your tenants as
Absolutely.
well. You don't.
Absolutely.
It's such a slippery slope, and I see people try and cut corners, going, "I'll just rewire that light switch."
Never,
or whatever.
never, ever,
Don't
ever.
touch it. It's really good. But for me personally, I love to renovate. I love getting my hands dirty, but I'm conscious it's time as well. So the reason why, one of the primary reasons why I use a buyer's agent, not the fact that they can do everything they can do better than me, is that I'm time poor, right? Like my weekend's my family time, and I'd love to be renovating, but I prefer to spend time with my family. So
100%.
I'll get most of my renovations done by people who are
and it's cost effective though.
It's cost effective.
You might
want
want
to
to
do
do
it. It's time. Time is worth a lot.
Time is money, and if you're going to go out there just on weekends to paint your property,
it's going to take forever.
You'll be there for 4 weekends.
I had a podcast the other day, and I won't dwell too much on this, but it was a young couple, great young couple, and they've done really well out of it. But the guy was a carpenter, and they took a whole year to renovate a property with no one in there. It's like cash flow. Cash flow. Anyway, they got a good outcome out of it. So we're going to have to wind up, Steve. But and I'll direct this question to you, because I've had some experience with you in that you do a renovation.
Yep.
For all the reasons we've spoken about, you need to wait a bit of time for it to percolate, and whether that's waiting for the market to recognise the value of this property, or it's waiting for a lender to be comfortable enough and say, "Oh, that's now worth $50,000 more than what you paid for it X number of years ago." So you got to wait for that time in the market. But then there's also the perception of the valuer. So you mentioned how you can create an experience for the valuer. So from curb appeal through the front door through to a great thing inside. But if it's a short period of time between X and Y, and you spend a lot of money on a renovation, how can you best package that property up for a valuer so you can best highlight to them what you've done with it, and therefore should quantify a much higher valuation?
That's a good question. So the reason to get a value in a short period of time would usually mean that you've made a massive difference to the property, or you'd want to hope so. So what we always do is we'll take photos before the renovation starts, so in its worst possible condition, so that not only do you remember what it's like, but you're going to show the valuer down the track on what it was like and where you've taken it to. And then you'll show progress photos, and then you'll also make a list of exactly what you're doing and how much you're spending, all the way through to the finished product. And this is what's really, really important. You need to put yourself in a valuer's shoes, and you want to become the valuer. So you're going to create a report just like they would. So you'll jump onto the computer and use tools such as RP Data as an example, maybe realestate.com, domain, whatever, and you're going to get relevant sales history to what you have. So apples for apples. You're going to value this property like a valuer would, and you start to create the report with number 1 Smith Street is the same product as this, and it's sold at X, and you're going to get as much of this history as you can around about the same time. And this is the important thing. You don't want it from years ago. You want it within a 3-month
So you
period.
you can control the perception of the valuer through.
No, I would never say that.
No,
they would.
But
You're helping them.
You're helping them.
Yeah.
But you're helping them do a lot of their work. That is, this is like for like comparable properties.
Correct.
You're giving it a substantiation.
Yeah, but the biggest, and look, some valuers love it, some valuers hate it, because they might think that you're telling them their job, but it's not. They don't get a lot of money. They've got to do a lot of valuations in a day, and sometimes they miss comparables.
Yeah.
So you want to make sure they don't miss those comparables. But I think the biggest key when you create this report is that you need to get at least 2 real estate agents' market appraisals. So if you're going to sell
get a letter and say,
get a letter on their letterhead and say, if we were to market this property and put it
That's
for
a great
sale,
tip.
Yeah, it'd be X, because that's from the salesperson's mouth, so to speak. And then if you have the relationship with your buyer's agent or your real estate agent or your property manager, I should say, give them this report bound up nicely, just like a valuer would, and have them meet the valuer on site. So they need to have that communication and rhetoric as when the valuation is going to happen, and then hand them the report and speak to them. That doesn't mean shadow them. doesn't mean get in their way.
Let them do their job.
Let them do their job.
Just give them a little bit of a help.
Yep, give them a little bit of help and then just walk away.
Good point. Good point. So lots of concepts we've spoken about today, and we've only really touched on them. And it'd be rich of me not to do a standard disclaimer in that this is just a general conversation that we're having. Obviously, everyone's, as we touched on, circumstances are different, so you need to make sure that when you go into any financial decision that you ensure that you got the right support and advice there. So, but to wind up, Victor, you guys would be happy if any of these terms people don't really understand completely. You're happy to have a chat with them.
Absolutely.
And, yeah. So, what are they? How can they get in touch with you guys?
So they can write to us questions at rightpropertygroup.com.au. That's RIGHT, or they can send us a private message on the Facebook page.
Okay.
Or just reach out on our website.
I do encourage you to do that because I like this, the whole art of manufacturing equity. There's so many different components of it through great research and buying well and renovating well, and really, and it's the big point is understanding how that fits within your total strategy and what you're trying to achieve through property investment. Obviously, through property investment, we're all trying to create wealth. It's an inherent aim of everyone, but I'd also make a point that you want to have a bit of fun along the way as well, Victor.
Absolutely.
You've got to enjoy it, right?
You've got to enjoy it. You've got to enjoy it. You've got to enjoy it. And renovating is something where for a lot of people who may not be in a position at work where they can dictate the growth of the business or their particular career path. This allows people to sort of take control and get some skin in the game and have some fun. So
absolutely, but just remember, you don't have to renovate. It's only there to amplify the potential.
Yeah, good summary. All right, nice one. Thanks, guys. Really
Thanks,
enjoyed
mate.
it.
See you next month.
Yeah, we'll be back next month. If, as I mentioned beforehand, if you're new to this podcast, please scroll through all the previous issues. We've covered quite a lot, and I'm sure you'll enjoy them. But as Victor said, get in touch with them if you'd like to have a chat with it about any of the different concepts that we've spoken about, or you just want to have a chat in general. I know from experience that these guys are happy to have a chat and just to really chew the fat and understand where you're at. So I look forward to being back again next month. Bye bye.